my asset is in a self-directed IRA. I'm assuming if I sell it, the money is considered income and I'm taxed on it like any other income. Can we just stop right there?
Yep.
Let's just kill that assumption.
So there's a whole lot of misconception going on in this question. You have an asset in a self-directed IRA, fine. If you sell it, is it taxable? No. You can sell anything you want within the IRA and the money just goes back in there. There's no tax event going on when you're in a retirement plan such as that. So no, we are not taxed on it like any other income. It's quite the opposite. And you can do that and you just get more cash in there, and then you go out and get your other investment within the IRA and it will continue to grow tax-free. That's it.
It's an exempt entity. So as long as it's in there, the only time you have to worry about tax in a self-directed IRA is if you have unrelated debt financed income, which in English means you have a loan on the property that's creating the income, in which case then a portion of it may be subject to tax because you use leverage. That same rule does not apply to a solo 401k or a 401k. So if you're investing, it helps us to know, hey, if you're talking to us, we're like, hey, you know what? If you do it over here, there's a small tax. You do it over here, there's not. Do it over here, right? But there's no income. Now let's answer the rest. Also, if I use the money from the sale on that property for the purchase of a different property not kept in the self-directed IRA, can I avoid taxes? What is your suggestion in this kind of situation?
So now what we've done, we sold that property in there and we want to take the cash out. Now we have a taxable event. Okay. Can we do things out to offset there, outside? Yes, but know that that will be taxed and we're not going to be able to do anything on that particular transaction. Tax will be paid unless we find other things, such as you go out and you get maybe one of those short-term rentals we just spent, 10 minutes.
Create a loss to offset.
Exactly.
And you're saying, hey, I want to distribute the money. You have the penalties depending on what type of IRA. It doesn't say Roth IRA, so I'm going to assume that this is a traditional 10% penalty plus your tax. If we can make it low enough, we're good.
Yep.
And or if you convert it over to a Roth, that's another way, but then you're still in the plan. I wouldn't get it out of the plan.
No.
Honestly, it's good to have it in the plan. You're going to end up paying tax on it, but it might be 20, 30 years from now. Let it grow. Yeah. And so, so the answer is don't take it out unless you want to incur tax. But if you're going to incur tax, minimize it by using deductions from other activities to offset it. And so we have this all the time where somebody has money in a defined benefit plan, an IRA, a SEP IRA, a simple IRA, a 401k, a 457, whatever it is. And they had a really bad year, or they had a black swan loss event where they were able to maybe they qualified as a real estate professional and they accelerated a bunch of depreciation into 1 year and they ended up with like a $500,000 loss. And they're like, I could carry it forward, or let's create $500,000 of income by taking money out of an IRA or rolling it into a Roth, in which case that's a very wise decision to do that. I would probably say keep it in a plan, but make it a Roth rather than take it out and use it individually. Somebody says, but don't you need to pay for all the repairs with the money from the self-directed IRA, and all the rental income has to go back into the self-directed IRA? Yes. You cannot pick up a hammer and do work. That's your personal services making the asset more valuable. You can't do it in an IRA or a 401k. You're a disqualified party. You can't do that. If you like this clip of Tax Tuesday, then I invite you to join the actual show. It's every other week, and you can ask your questions and get them answered live by myself and my team. Just click the link.